started before when I first started talking to you. Oh, so let's do some of this deferral and accrual stuff, some cash transactions. Okay, so let's buy some inventory on account. Let's buy $5,000 worth of inventory. What's inventory? Product. It's going to be a debit because it is a asset. What is it though? It's a product that I'm buying from someone that I'm going to resell to the customers, right? So it's going to be an asset to me, right? It's an asset until I sell it. What's going to become when I sell it? An expense. The major cost of what I sold. And cleverly we call it cost of goods sold. Yeah, this is just obvious stuff. Okay, so are you angry today? I just got here. Yeah, glad not to be at work. Yeah. Anyway, so let's buy this inventory. What did I say? 5,000. Debit what? Inventory. Very good, guys. Brilliant today. Okay, debit inventory $5,000. We'll put it over there on the left. Credit what?
5,000 cash.
No, I said an account.
Yeah.
What does an account mean? Almost always it's on account when you buy inventory. You can buy it for cash if they require cash, but usually it's on account. You're going to pay them later, right? Everybody agree? So what would that be? Open account, accounts payable, which is a liability. Yeah, more so, that's why you are crediting it. Yeah, good. All right, you guys got it. I know I just say the same thing over and over, don't I? Until you get it, okay? It'll work out good. All right, so then let's say that we sell $2,000 of that product for cash, and we sell it for $3,500. So my sales price is $3,500, and the cost of the product is $2,000. Got the idea? I'm going to have a gross profit on it of $1,500 then, aren't I? The difference, right? I'll have other expenses too, so I don't really have that much net income on it, because there'll be a whole bunch of salary expense, rent expense, right? Okay, utility expense, all kinds of other things. So what would you want to do? If you sold it for cash, for $3,500, what would be the debit and credit? Debit cash, because you have more of that asset, right, guys? And that's the way you think about it too, right? You don't memorize these entries. You can figure them out, can't you? Okay, and credit what? This is how I earn my revenues, right? In the ordinary course of business, this is what I do. So what do I call this stuff? Well, it's not services. I'm selling product. If it was services, I'd be some sort of service revenue account, like we did gardening service revenue last time. This, I'm selling products, so I call it sales. That's it. Just by convention, that's what we do. Okay, so we can either call it sales, which most people do, or if you want, you can put the word revenue on it. And for now, let's put the word revenue on it so we know that's a revenue account. Okay, guys? Sales is a revenue account. Okay? Just like cost of goods sold is an expense account without the word expense on it. Everybody good? Most expense accounts have the word expense on it. It's really nice. They have the word expense, you know it's an expense. Most revenues have the word revenue on it. So the word revenue there is revenue. Unless it's unearned revenue, then it's a liability. Yeah, so, you know, or if it's prepaid expenses, then it's an asset. So a little bit, you have to be a little careful with it. Okay, now that's only half done, isn't there, guys? Don't I have to do something else? Yeah, I got rid of the inventory. You sure and do that, right? So what would you want to do? I don't have the inventory anymore, so what do you want to do? Credit it, because I have less of that asset, right, everybody? Everyone's staying with me on this. This is just getting to be automatic, isn't it? Okay? Notice I didn't put the accounting equation up and the rules for debits and credits. That's because you know it as well as your name now, huh? Oh, close. Right? It's just automatic. It's just automatic. Okay? So what we'll do is we'll credit the inventory account for the $2,000 we took out. How much inventory we have left now if we just started the business?
3,000.
Yeah, about 5. And then I sold 2. I guess I have 3 left. Do you think so? Okay, and what do I want to debit? Accounts receivable? I don't think so. No. When I sold this stuff, I sold it for $3,500. I debited cash and I credited sales. Oh, it's an expense. What is the major cost of getting somebody to give me that $3,500 cash? So I earned the sale at the same time they gave me the cash in that case, right?
Cost of goods sold.
It's cost of goods sold. What's the major cost? I have to give them the inventory. The product, right, guys? When you go to the grocery store, if they don't let you take the groceries out of the store with you, will you give them your money? I kind of doubt it. Why do they have the inventory there? Kroger doesn't want to have food there. What do they want to have? Your money, right? They want you to leave your money there. And in order to get you to do that, they have to give you something, which is the inventory. Got it? It's that simple. This is stuff you already know, isn't it? Okay? So you know what that was, you guys who got that thing wrong? You're trying to remember it. Stop it. You're figuring it out every time. One piece at a time. One debit, then credit, then a debit, then a credit. Got it? Okay, so we look at this thing and say, okay, I gave them the inventory. I no longer have it. They walked out the door with it, right? Out of my store. Credit inventory. What do I debit? It's the major cost of getting my sale, so I call it cost of goods sold, which is a what? Expense. And how do you increase all the expenses? Debits. This worked out good, didn't it? Okay, so we got cost of goods sold. It's funny how it always does. The reason I went into this field is it's so easy. And you get paid well for it. What an amazing profession. Okay, anyway, so debit, cost of goods sold, credit inventory. Again, I suggested the gross profit was how much? Yeah, you bought it for $2,000, you sold it for $3,500, it's $1,500. How do we get that in the financial statements? What are we going to show on the income statement, guys?
3,500 revenue minus 2,000.
Yes, 3,500 revenue minus 2,000 expenses, and that's the 1,500 gross profit so far. Got it, guys? That's going to be in net income, less all the other expenses we have, right? Okay, yeah, all right. So let's see, let's do something else. Let's pay an employee who worked this month, and we used up, we're going to pay him, I don't know, $1,200. We're going to pay him $1,200. They worked this month, got the benefit of their work this month, and we're actually paying them this month. So let's record it when we pay them. What we do. Debit what? Credit what? You can do the credit first if you want. I don't care if you do the debit or credit first, as long as you write the debits to the left and write them first. So leave some room if you do the credit first. You write the credit. You can write the credit first and then do the debit. It doesn't matter. Well, what's the credit? Oh, wage expense isn't the credit. It's the debit. Yeah. What's the credit? Cash. Sure, I gave you cash. I have less assets. Credit cash. Why do you want a debit wage expense? Because you incurred it. They're trying to generate revenues for you. They're probably selling this inventory for you or something, right? Get the idea? Okay, so that's an expense you incurred, right? And how do you increase expenses, everybody? Debit, all of them. You know, we debited cost of goods sold to increase it because it was an expense. This is going to be salary expense, isn't it? That's what he said. I agree with that if it's a salary, right? So I debit salary expense because I have more. Okay, good. So debit salary expense. I don't know what did it say, 1,200? Credit cash. Okay, now I've got two cash expenses, or I have a cash expense here. Right, I'll get it. I have a cash expense here, don't I? Everybody agree that that's a cash transaction? Okay, so there's a cash expense. Cash now, right? That's what I called it last time, huh? Cash expense, cash now. Okay, and then this is cash now on a revenue, huh? You guys agree with me? Okay, so let's try something a little different. Let's say I sell another 1,500 of that inventory for $2,200 on account. So I sell, the sales price is going to be $2,200 on account, and the inventory cost me $1,500. And I give it to the customer and they leave. What do you want to do? What do I want to record because I sold them $2,200 worth of product, sale price?
Debit 2,200 accounts receivable.
Okay, it's account receivable because that's what? The asset I received. It's not cash this time, it's accounts receivable instead, huh? It's fine though. They promise to pay me later. It's a real receivable if they have both the capacity to pay me, right? And they intend to pay me. In other words, they're not stealing from me, I guess. Right? They have the intention of paying me and they have enough wealth to pay me, the capacity to pay me. We'd say it's realizable. What do I mean by realizable? Realized or realizable? What does realized mean? I got the cash. What does realizable mean? I'm going to get the cash. It's highly probable. Got the idea? If I got the cash already, I already realized it. So that sale, it was debit cash, credit sales revenue, I realized it, okay? This one, debit accounts receivable and credit sales is what we're going to do, is going to be not realized yet, but it's realizable. What does recognize mean? Recognize something. You recorded the journal entry. You put the revenue on the income statement. You put the expense on the income statement. You put the asset or liability on the balance sheet. You recognize the transaction by recording it. Recognize means put it in the financial statements. Realize means the cash changes hands. Those don't necessarily happen at the same time, right? That's what we're getting to here. That's what made chapter 4 kind of a pain. What's going on here? Okay, so what would this entry be again then? You guys wanted to debit accounts receivable. I agree with that because we have more of the asset accounts receivable. What did I say, 2,200? And what would you credit for 2,200? Yeah, it's the same sales revenue we have up here, isn't it? It's just that we sold it on account, right? Instead of selling it for cash. It's still sales revenue. I still sold the product, right? Excellent. Okay, now, that sales revenue, in this case, is that a deferral or an accrual of revenue? I am recording the revenue before I got paid. Deferrals and accruals are not talking about cash flow. They're talking about revenue and expense. Did I defer revenue or accrue revenue? Defer means put off. Accrue means speed up, right? What did I do? Now they're deferring payment. That's cash. What are they doing to revenue? We're recording it now. We're accruing the revenue. And that's what always screws everybody up, get them backwards. Okay? So this is an accrual of revenue. What I'm accruing is the revenue, guys. Accrual of revenue. And then we call accounts receivable an accrued revenue account, right? Because it is. Okay? So that's an accrual of revenue, right? I'm accruing the revenue even though I didn't get the cash yet. Okay? All right, good. Okay, let's do something else then. Let's collect that. Oh, no, first, I didn't finish the entry. What else do I have to do? What did I forget? Oh, we gave you $1,500 worth of inventory. Got to remember to do that. Yeah, or we'll be screwed up, right? We won't have enough expenses, and we'll have too much assets. We'll have too much net income, right? And too much equity. Too much assets and too much equity. We didn't make that entry. We'll get to that stuff later. Okay, so let's do that. Let's do the fact we gave you the inventory. What do you want to do?
Cost of goods sold.
Sure, it's cost of goods sold just like that one, isn't it? Excellent. More expense, what did I say, 1,500? And credit what? Inventory, just like here. What's the gross profit on this one? 700 bucks, right? About 1,500 sold for 2,200. Fantastic. Everybody good? Okay, so now let's collect that 2,200 they owe me. They pay me the $2,200. What would I do? I got cash, an asset named cash, debit cash. Increasing that asset, right? And credit what, guys? Yeah, I don't have sales again. It's accounts receivable goes away, right, guys? They're just paying off this account receivable right there. Excellent. So I increase one asset and reduce another. Is that okay with you guys? All right. No big deal. All right. Let's say that I use my building and it costs $2,000 a month. So I use it for this month and I'm going to pay them next month. So I use it this month, I'm going to pay them next month. Sound okay? Right? $2,000. So I got the use of the building this month. I used it up. I'm using the building, it's my store, maybe. I've got my product in there, this product we're selling. Everybody got the idea? So I am incurring the cost of renting the building in order to try and do what? Generate sales revenue, right? Generate revenues. Everybody agree? All the costs associated with generating the revenues are called expenses. What would be a really clever name for rent that you'd like to expense? Rent expense, yeah. You can't screw these up, you guys. Students ask me, what do you name things? What it is? I don't know. I call trucks either trucks or delivery equipment or equipment. I don't call it big things with four wheels and a tailpipe. I mean, the last description probably is relatively descriptive, but I don't know anybody that calls trucks that. Okay? But companies can use whatever they want. They can call a truck, or they can call it delivery equipment, or they can just call it equipment. Everybody got the idea? Right? So they call it something that makes some sense, right? That most people would use. So that's what you try to do. Okay, anyway, so I suggested that it was $2,000 of rent that we used up, and let's say I said we're going to pay for it next month, right? So it'll be paid next month. So what do? What do I want to record seeing as I used it up? I want to, what? No, he's back on the truck. No, this is,
Sorry.
I'm sorry, it's the building I rented. Sorry, I'm going an example in between, yeah. Don't change my train of thought, yeah, that's why I couldn't get back where I was. Okay, so I got $2,000 of rent of this building I've used up, and now I owe them, right? But the fact that I used it up means I have what? An expense, named rent expense. And how do you increase expenses? Debit. Oh, this would be great. Debit rent expense, guys. Everybody's sitting there saying, I know how to do this. I wish you'd just quit screwing it up. Okay. And then credit what? Well, we probably wouldn't call it account payable. This is going to be an accrued liability. Rent payable, probably. Some companies do call it accounts payable, but probably rent payable. Usually we use accounts payable for inventory. Oops, that says payable? Sure it does. Okay. Rent payable. Usually what we do is we use accounts payable for inventory purchases, and then we'll have different kinds of payables for different things. Salaries payable, rent payable, taxes payable. Got the idea? Interest payable. Okay. So now we've got debit rent expense, credit rent payable. Let's pay that one. Oh, by the way, what is that? It's an expense that I haven't paid for yet, but I've recorded it. So yeah, that's going to be cash later.
It's recognized.
So this was accrual, and it was cash later on revenues, right? So we've recognized the expense, but have we realized it yet? No, you guys are getting there, that's good. Okay, so what is this? This is cash later also. Is that an accrual or deferral? What happened to the expense? I recorded it, even though I haven't paid it yet. What would we call this? An accrual. It's an accrual. The cash is deferred. We're not talking about the cash, we're talking about the revenue or expense, right? Seems ridiculous, doesn't it? But that's what we do. No. A deferral is I am deferring the revenue or expense.
Why would you ever do that?
Oh, would you let somebody pay you in advance? Does the insurance industry like being paid in advance? That's a deferral of revenue. Yeah, right? You'd like it too if you could, wouldn't you? Get the money in advance?
Yeah, exactly.
Yeah, that's right. Okay, and why would we have deferred expenses? Does anybody ever make you pay them in advance? Might your landlord make you pay them in advance? Right? Prepaid rent. Might your insurance company have you pay them in advance? Absolutely. Prepaid insurance. Okay? But what we're deferring is the expense, right? Or we're deferring the revenue. When we're accruing the revenue or expense. You got to separate cash flow. Okay? I know they have deferred payment here, right? But you are accruing the expense. Okay? It's easy to flip them. It's easy to flip them. Okay? So let's do a couple deferral entries then. We've done a cash expense, right guys? It was cash expense. I did cash revenue up there, remember? Cash now and revenue. This is an expense. It's cash now. This is a revenue that's cash now, right guys? And then we've got a revenue that's an accrual, cash later. Okay? And we've got an expense that's an accrual, cash later. So what's left? Cash in advance, of course, right? So let's give that a shot. So let's say that we pay an insurance premium for the next year, and it's $3,000. We pay it now, right? And let's make this be January 1st, year one, and it's for the next year, okay? It's January 1st, year one, and it's for the next year. Okay, that's 111. You like that? Okay, January 1st, year one. Okay, here we go. What did I give them? I gave you $3,000 of cash, which is an asset, and I have less. What do you want to do with it? Credit. And then what do you want to call that? The debit? Prepaid expense. You can put the word expense on it if you want. Most people don't. You put the word prepaid in front of the expense, it's no longer an expense, it's now an asset. Because it's an expense I paid in advance and I'm going to use up later. Things that I possess that I am going to use in the future are my assets, right? As I use them up, they cease to be an asset and become an expense, costing for to generate my revenues, right? So this prepaid, debit, prepaid, I said insurance, right? This debit to prepaid insurance is buying an asset, okay? Now let's think about this. So I have more asset and debit increasing. Let's say that I was willing to rent a $2,000 a month apartment downtown for you. My wife would like me to do that. She wants me to buy it instead. Yeah, condo. But anyway, let's say I was willing to rent it for a full year in advance for you. So I'm going to plunk down $24,000. I don't have $24,000 over. I won't do this to you. Anyway, so I paid in advance. Would you think you had an asset if you had the right to live there for 12 months rent free? Yeah. If you paid for it yourself, do you think you'd have an asset? Yeah. Right? You took $24,000 in cash and you bought the right to use a building for a year. Right? Use an apartment for a year. Does everybody agree with this? So if I pay my insurance policy in advance and I get that insurance coverage without paying for it again, do I have an asset? Yes. Does the asset go away as time goes by? Well, of course, you used up the insurance. What does it become as the time goes by, you guys? An expense. What would we call expenses for insurance? Insurance expense, yeah. Okay, so good. So this would be what? An accrual or deferral of expense? What do you think? Yeah, I'm putting the expense off, right? I know I already paid for it. We're not talking about what happened with the cash flow, are we? We're talking about what happened with the expense. I've put off the expense. So this is a deferral, good, of expense, which is what? Cash in advance, right? Cash in advance. And this one's going to be an expense. Good. All right. So now let's say it's the end of the year, just to make our life real easy so far. December 31st, year one. Okay? Yes, sir.
Would cash in advance go with revenue?
No, that'd still be a deferral. If I got cash in advance,
So
it'd
cash
be
in
deferred revenue, which we're going to call unearned revenue. This is a deferred expense that we call a prepaid. And we'll do that as soon as we're done with this one. Okay? If where you would accrue revenue is debit accounts receivable and credit sales. I'm recording the sale even though I haven't been paid yet. I'm accruing the revenue, not the cash. Okay? Okay. Yeah, I know, it just turns the brain inside out. All right. So what would we do at December 31st with this thing? What is it? What is that prepaid? What happens to prepaid insurance after a year's gone? If it's for 1 year.
It's used up.
It's used up. So do you have the asset anymore? No. So what would you do with the asset? You turn it into insurance expense, right? I have insurance expense because I used it up. It's an expense of running my business, right? Generating my revenues. So you want to debit insurance expense? That's how you increase expenses, right, guys? With debits. Always go back to that. If you can't figure out what you're doing, get back to that accounting equation, right? And what happened, okay, with those 5 accounts. So sure, debit insurance expense. I think so for the whole 3,000. The year's gone by. Actually, what we do is every month we do 1/12 of it. Oh. Right? We do 1/12 every month. We'll get to that. Right? Anyway, credit what? Yeah, it's gone. It's an asset you used up. What do you do to assets to reduce them? You credit them. This is just a miracle, right? Okay, so we've got it, huh? Okay. I got somebody's head of hate curtain already. I like it. It's good. It's a good day. It's the only reason I do this. That's to punish you guys. Okay, torture. All right, let's do unearned revenue then, huh? Oh, let's do deferred revenue, unearned revenue. What happens? Okay, so now my customer pays me $3,000. I just did three. $2,500. My customer pays me $2,500 for product that I am going to deliver, or services. I'm going to do services. Services I'm going to deliver later. Okay? I'm going to deliver some sort of services to them later. They'll have service revenue when I deliver it. Okay? So if they give me $2,500, what do I get? I get cash. Debit it, right? Good. If I'm not going to earn it until some future month, what will I do? It's unearned service revenue, whatever the service is. Cleaning revenue, gardening revenue, okay, whatever it is. Insurance premiums, right? Unearned insurance premiums. Unearned rent revenue. And the landlord may get paid in advance. Okay? All right. So, by the way, how many kinds of unearned revenue could there be? Oh, geez. How many services do you sell? That's it, right? Okay. All right. So, debit cash, credit unearned service revenue. What did I just do? What did I just do? I put off recognizing the revenue until I earn it, even though I got paid. What's that? I deferred the revenue, right? This is a deferral of revenue because I have received the cash in advance. I don't want to recognize the revenue until I earn it, do I? Everybody agree? You wouldn't want to do that. Okay, so then what would I do? Let's say I've now delivered the services the next month, so I deliver. Because I delivered services, because I have completed the earnings process, delivered the services, what am I going to have? Service revenue. So I think I'm going to credit some sort of service revenue account. Okay. What don't I have anymore? I promised to do the services for them, and now I have. That was a liability. This thing was a liability, right, guys? I owed them the services. Everybody good? Now I don't anymore because I delivered it. So what do? Get rid of the liability with a debit. Got it. Good deal, huh? Can you guys do this? No problem. You know what? If you can do these 6 things, cash there, cash expense, an accrual of expense, an accrual of revenue, a deferral of expense, and a deferral of revenue, those 6, you can do everything. You can do virtually everything. Really, your debit inventory, you're deferring recognizing expense until the debit possibly sold credit inventory. Nobody thinks about it that way, but you really are. When you buy a building, you get the building, credit some sort of payable, probably cash maybe too. What do you do with the life of the building? It's like a prepaid asset. What do you do with it? Use it up. If you use it up, we debit depreciation expense and credit accumulated depreciation, and the building is going away. Okay. Now, accumulated depreciation is something new, isn't it? That is a contract asset. I already lied to you. A little white lie. You know, it's like when your girlfriend, your wife, your significant other of whatever type says, does this skirt make me look thinner? What is your answer? Yes, sweetheart. You're not lying, it's self-preservation.
Until she finds out you lie.
She never trusts me on anything. She knows I'm not going to forget. No. She always looks better. Yeah, always looks better. Every day. Yeah, anyway. So that's okay. She stays married to me, and we don't understand why either. So we don't know why she married me in the first place. So if you ever see her, you'll know what I mean. Really very attractive woman. So yeah, and smart and all that. But you don't need, right? Yeah. Okay. Actually, she's been nice when she used to be the MBA director here, and all the MBA students would say, "Why is she married to you?" I'm not kidding. It really would. London told me. I had to ask you. You know, we've had you in class. You've not been a nice guy. Yeah. I don't know either. So,
What did you do?
huh?
What did you do?
What did I do to get her to marry me? I don't know. Yeah. Amazing. Yeah. Yeah, well, she thought I was going to. I'm a doctor, and then I'm the wrong kind. Yeah, you got it. Can't heal anybody, and don't have any money either. Yeah, wrong kind of doctor. Okay. Anyway, why were we talking about that?
You brought it up.
I know. Yeah. Oh, white lie. Yeah, thank you. Took me right back there. That was excellent. Okay. There really are 10 kinds of accounts, you guys, not 5. Yeah, I know, it's kind of a big lie, but here's the deal. There are contra assets, there are contra liabilities, contra equity, contra revenue, and contra expense. There aren't very many of these, right? They're not lots and lots of them. And they're real simple to get the idea. But first, just contra means opposite or opposing, okay? So a contra asset, how do you increase assets? What's the normal balance in an asset and how do you increase it? With a debit, and you reduce it with a credit. Guess what for a contra asset? How do you increase it? It's the opposite, with a credit, which gives you the balance of a credit, right? Normal. And then how would you reduce it? With a debit. Good. Liabilities. Normally you increase, always, you increase those with a credit, reduce them with a debit. So what would you think about a contra liability? Increase with a debit, reduce with a credit, right guys? Equity, exactly the same thing. Revenues, how do you increase it? Credit. How do you increase a contra revenue? Debit, right? And expense, how do you increase it? Debit. How do you increase a contra expense? Credit. Okay, so once you have that down, as we add each one, that's how it's going to work. They're offsets, right? Just 1 second. We're going to show building or equipment less the accumulated depreciation. So the building's a debit, right? The accumulated depreciation is a credit. The debit less the credit is the net building that you have not depreciated yet, right? It's the remaining building to use that you have left to use. So when you're looking at this in a balance sheet, you see how much the building costs, and you see what the accumulated depreciation is. You can see about how old it is. What if the building cost $1 million and there's only $100,000 accumulated depreciation? It's a pretty new building. What if it cost $1 million and it's $950,000 accumulated depreciation? It's about used up. You got the idea? And you're getting towards the end of its life, and you're going to have to spend a bunch of money on it. So it's kind of nice. What, by the way, if we use up the building, why don't we just reduce the building? Why don't we just credit building? Why do we credit this accumulated depreciation instead of increasing it? Why do we do that? The building's still there. We want to leave the building at its original cost. It's still there. Or the piece of equipment's still there. It's just getting old, right? So as accumulated depreciation on that building gets bigger, the net carrying value of the building goes down because it's building less accumulated depreciation. Okay? Yeah.
Why is it a contra asset?
I don't know anybody that accumulated depreciation. Yeah. Makes sense? And then on liability, we're going to have like a bonds payable, where a company issues bonds, we'll have a discount, right? Which means it was issued for less than the face amount of the bond. So it's a $100,000 bond, but we only issued it for $98,000, so there'd be a $2,000 debit in the discount, just to keep track of what it was really issued for. So again, it doesn't change the bond, it's still the same bond, right? Okay, so it's not liability, or not an asset in the case of a contract liability. That's a great question. And then on revenues, what we're going to do is we'll have sales, less sales returns and allowances and sales discounts. So you show the full amount of the sale, less the return or less any discount you gave your customer. So you can see how much those cost you. Same thing on purchases on the expense side. When I buy stuff, there'll be purchases, right? And then there'll be purchase discounts and purchase returns allowances. So we can offset them. In equity, there'll be debit balances in things like dividends. You use a dividend account later on. So and treasury stocks and others. So where I buy back my own stock. So this is sort of the tip of the iceberg. You know what? I just listed a whole bunch of accounts that you don't know what they are, right? What's the first question you should ask if you wanted to account for any one of those accounts?
What's an example?
No, what's something simpler than that? There are only 5 kinds of accounts and then the conflict of those 2, right? What do I want to know first? What is it? Let me give you this one. This one's okay. Goodwill. You guys know what goodwill is. Goodwill on Christmas, yeah, right? Goodwill. Yes, one time they goodwill. Hey. Goodwill, right? What's goodwill? Actually, you can't account for it unless you know. Basically, what would you like to know first? What is it? No, what is it? Is it an asset? Is it an asset? Is it a liability, equity, revenue, or expense? It's got to be one of those. So what if you do that first? Even before you know what goodwill is. I'm not going to tell you what it is yet. You already will know how to account for it when I tell you that it is a asset. Did you already know that? It's an asset. Okay, good. It's an asset, isn't it? So therefore, how do you increase it? With a debit, how do you reduce it? Credit, because that's how all assets work. So what do you want to know immediately if you're going to account for something? What is it? And what we mean by that is asset, liability, equity, revenue, expense, and now we know how to account for it. Then, well, what is it? What is it? I mean, that's the important piece. But what kind of a possession is this? One business buys another business. and they pay more than the fair market value of all the assets they got, less all the liabilities they assumed. So it seems like they paid more than the business is worth. That's the equity, assets less liabilities, right? It looks like they paid more than the equity to buy the business. What's that for? How many of you have a favorite restaurant? You got a favorite restaurant? Most people do. I like that price. Can't go there often. I like that price a lot. Okay, really good price. You know what? That price has people working there, and they have tables and tablecloths, and they have a bar, and they have, they have not a very fancy building, really, right? But it's kind of neat. And oh, they have a chef that is just unbelievable over the edge. And they have good service too, right? So do other businesses have all the things they have with the exception of the chef and the service? They really get good. Yeah, there's a lot of life. I don't like them anywhere near as well. So if you were going to buy Jack Fry's or whichever restaurant you really like, would you pay more to buy that restaurant than another restaurant that had exactly the same stuff, all the same assets, same employees, everything's the same, except this is a wonderful place and the other one's kind of mediocre? Which one's going to generate more future tax flows? Jack Fry's is, absolutely, right, unless you lose the chef when you buy business, okay? But it lets you screw it up. So what is that difference we paid, that excess we paid? That's called goodwill. That's it. It's the only way you can get goodwill. Otherwise, you and I would start a business and we'd record goodwill on our financial statements. What we do is we run it for a year, probably lose a whole bunch of money, and then at the end of the year we'd say, oh, we have $1 million worth of goodwill, because everybody loves us. So we just got a goodwill and credit gain from building goodwill. There's no such thing as that, right? You can't do that. You can't just revalue things because you feel like it. You have to have a business transaction. Sort of like in my house, my wife and I bought it for $170,000. I hereby decree it's worth $500,000. Why not? We've had it 8 years. Maybe I'll just put $500,000 on my balance sheet, my personal balance sheet, instead of the $200,000 or so that it's probably worth, or $190,000 or something. That's a little tiny stuff. We're back in high school. I live my goal. So that's what they call them. You've seen these little two-bedroom things. You've never seen a house that small. Okay, anyway. So didn't know houses were that cheap. So I could put $500,000 on my balance sheet, but it wouldn't mean anything, would it? And therefore, I'm that much wealthier, right? I'm now $330,000 wealthier because I write $500 on my balance sheet. No, you don't do that. Okay, you have to have some basis for it. So, okay. Anyway, things we're going to be getting to. All right, you guys, I'd like you to tell me then on this, what happened to the balance sheet? Let's do that again. What happens to the balance sheet here with these transactions? Oh my gosh. It's easy. You know what happens. You made the journal entries. What do you think the first one does to the balance sheet? Here we go. Assets equal liabilities plus equity. And also, I should have said to the income statement too, I guess. Revenues, expenses is net income. Okay, just do this over and over. What's the first one do? Increases assets $5,000 and increases liabilities $5,000. So you have to know that, and you couldn't have made the journal entry. Author makes a real big deal out of it in the problems, don't they? Because you need to know that in order to make the entry in the first place. Okay? What does the second one there do? What does this one do? That increases assets too by $3,500 and increases revenue by $3,500, right, guys? Which increases net income, which increases retained earnings, which is an equity account. Equity. Absolutely, it sure does. There's no question about it. Okay, so that's what that one did. What does this one do? What's happening here? Assets go down? Yeah, by the 2,000. Expenses go up by the 2,000, which makes net income go down by 2,000. Get the idea? Which makes equity go down by the 2,000. Everybody agree? What's the net impact on equity if you make it go up by 3,500 and then you make it go down by 2,000? I got revenue of 3,500. I got expenses of 2,000. The net effect is increase in income of 1,500. You can do all these, can't you? You can do all.
These went out again. The cost of goods sold Was that an asset then?
No,
That was equity?
cost, the cost of what I sold. What do you think that is? That's an expense. Yeah, I didn't get an asset. I gave up the asset. I gave them the inventory. And when they took the inventory away, it's no longer my asset, so I credited it. I'm not gonna get it back. And I don't have some other asset. They're not gonna give it back to me later or something, right? What I got is this, the major cost I incurred to get that revenue. The deal worked out pretty good though, because I got 3,500 for 2,000 inventory. Okay, did I do it? Okay, good. All right. So, do these guys. Tell me what the net impact is between these two entries. This one and this one. Just think about that. What happened? See, every time we make a journal entry, we're changing the financial statements. Have you figured that out? Right? We are. We make up these financial statements with all these entries. Imagine at McDonald's, millions of entries, all summarized. Make one sheet of paper, the financial statements. Okay? Millions of entries. Okay? Or Kroger or something. But it's okay, we got computers and they don't mind having them all. Right? No big deal. What did this do? Increase the account receivable, which is an asset, by 2,200, right? Increase revenue 2,200, and which increases net income 2,200 for that portion of it. I know there's cost of goods sold too, right? But we'll leave out the cost of goods sold for me. Okay? Now what does this do down here? Increases the asset cash, but decreases that account receivable, and that account receivable is now gone, isn't it? Look, guys, that account receivable, what's left? Debit, cash, credit, sales revenue. What did we do earlier when we had a tax sale? We debited cash and credit sales revenue, didn't we? Why would we bother with this? Let's say this is in January, and this happens sometime out in February, and you're doing monthly financial statements. What do you want to show at the end of January on your financial statements? You want to show the account receivable in your balance sheet, right? You want to show the sales in your income statement so that your net income goes up, so that your retained earnings goes up, your equity goes up, right guys? We don't want to show the cash yet because we don't have the cash yet. Everybody good? Okay. Then what do you want to show on February's financial statement? You no longer want to show the receivable because you don't have it anymore. You don't have that asset. So you reduce it. But you do want to show the cash because now you have that asset instead. That's it. Okay? Let's go on down. And let's do the same thing with this. What do you think? Yeah, it looks like I increased one asset by 3 and reduced another asset by 3. Right, guys? What does this do? Increase expense, which reduces my net income, right? Which reduces my equity. Well, wait a minute, I need something else.
You're also losing an asset.
Yeah, I'm reducing the asset. The prepaid goes away. So what's the net effect of those two?
Assets and equity go down.
Debit, insurance expense, credit, cash, just like it was a cash transaction. Right? Yeah, assets and equity go down. Absolutely. You got it, guys. Okay. Let's do one more thing with this. This rent expense and rent payable, I didn't pay it off, did I? Let's pay it. How do you pay off that rent payable?
With cash, right?
Yeah, so what would you do, debit or credit cash? Credit cash, if you were paying that off. And what don't you have anymore? The rent payable goes away, doesn't it? Everybody got it? You thought accounting was going to be hard. It's not hard at all if you work at it. Okay, now what happens here? Why do we do this? Let's say again this is in January and this is in February. Why do we do it? I want the rent expense recorded even though I didn't pay out the cash, right? So what's happening, you guys? And you can do it for any of these combinations. I have 2 more minutes, come on. Those who came late have to stay 2 more minutes. I'm kidding. Okay, anyway, so what's the deal here? What did this do? Debited rent expense, increasing it, right? Credited rent payable, increasing that. But then what else happened? That's these. This one right up here. Debited rent expense, credited rent payable. Come on, what is rent expense going up here? The net income goes down, which makes equity go down. So I had liabilities go up and equity go down. Okay. No impact on assets. Then what happens when I pay it over here? Assets go down. Liabilities go down. That canceled out, right? That rent payable canceled out there. And what do we have left? Debit rent expense, credit cash. Less asset, more expense, less equity. Everybody see these? Do the same thing with the deferred revenue and with the prepaid, okay? Do exactly the same thing. Oh, we did the prepaid, I take it back. Do the same thing with these unearned revenue ones. What is that going to look like? Real quick, here we go. You guys write them down. What is it? I see a massive amount of people writing something. Look at this. I want to leave, I want to leave.
Increased assets.
Okay, this increased assets, very good. This increased liabilities, excellent. And so if that was in 1 month, if this was in January, say, right, and this one's in February, just 2 different months, right? Okay, what happens? I change my balance sheet, but I don't change my income statement, right? There's no revenue or expense yet. Then what? That's decreasing the liability. It canceled out, didn't it? And you're increasing your revenue, which increases net income, which increases equity. Simple little model, huh? These 2 canceled out, didn't they? Cut out. Okay, nothing to it. Keep working, gang.